All right, there's our opening price. Here's decoupling. That's pretty expected actually when there's no news that's due out that morning, or this morning rather. And see how they're going different directions. That makes it a lot harder for precision to be available to you. Doesn't mean you can't trade it, just means that you're trading with a lower probability. I've done it before, but if you're a new trader, a new student, it's not something you should be trying to do. All three of the averages should be moving together. If it's a trading asset that you're, like for instance, I'm monitoring NASDAQ on the regular. So if that's my asset class, I want to trade as the indices for stock indices, and the specific instrument being the NASDAQ, I look for the S&P and the Dow to be moving in the same direction. If I'm wanting to be long, I want to see something that's supporting the idea for all three of them to be bullish. I'm watching this little gap right in here. I like the idea of that upper portion of that gap not being traded to. ES is making a lower low. Let's take a quick look at that. Let's come out on a 15 on this. There's your sell side there. I'm not going to label it because I don't really care so much about this one. And Dow is just a mess. If it runs for the sell side, it's just going to be one of those instances where the first percent of fair value gap doesn't give you an entry. And you remind yourself that it's decoupling. It means there's the mixed direction on all three averages. Dow doing its own thing reinforces the idea of being highly selective on the days that you want to enter, or the sessions that you want to enter on. You want all the things going for you in your trades. I'm watching this volume imbalance. You have a choice. You can sit and wait for the indices during the morning session to either come together in terms of agreement, or they start moving in tandem. Sometimes that happens in the same session. Sometimes it takes the morning session to sort all that out, and over the lunch hours, then the afternoon becomes a little bit better to trade. Or it can, on the worst case scenario, it can stay decoupled all day and make very problematic conditions for trading. Unless you're really, really short term and you're just taking the lightest, the things that would instigate you taking the trade, the smallest of things to do that, which I'm not a fan of. I don't teach that anyone should do that. The more things you have in your favor, the better. Let's take a quick look at Dow once more. I would not want to trade that. That's nothing there. It's really it looks like cheap bubble gum. All right, so we look at the ES. So far, the only thing that makes sense, even though it's not in agreement with any of the other two indices, NASDAQ still looks okay. And I'll go over what I mean by that. We've been weak. We did not get a return back into first percent of fair value gap. That's fine. We have bearish order block, trades up into here. Notice the bodies inside this gap. The bodies stay right at consequent encouragement or lower. These are the damage inducing events where the wicks are allowed to do that type of damage. And then we roll back down. Rotation out of the volume imbalance. Even with the decoupling, I would like to still see that sell side deliver. But then because it's mixed, I would like to see some kind of return back into the range, which is likely to see it come back under here. That's a scenario I'd like to see. I'd like to see it trade down into sell side, explore a little bit lower than that. And then if it can make its way back up in here, I would look for, as long as the Dow stays basically an unruly brat doing what it wants to do. And if the NASDAQ shrugs off any weakness as well. Back up into here, going into the second half of the AM session, that would be something I would look for. It doesn't mean it's exactly what I'm looking for. I'm looking for a scenario after seeing the sell side deliver like it just did here. One of the best things you can do is give yourself permission early on is to let trades pan out when it's highly unlikely for precision to be there. So we can still see elements to the things I teach, but these are the types of little things that'll probably mess you up, because you could probably look at this and say, okay, ICT said he liked this fair value gap. So maybe some of you pushed the button. If you did, you failed, because even though it did deliver where we're looking for sell side, it doesn't mean that you should have taken that trade, because if you've listened, even though it's done this, it's not a high probability trade. That means that these are the types of setups or movements and price action that I'm comfortable sitting on the sideline and just watching them paint and tape read them, watch them, observe them, go over them with my son if he's sitting next to me, or send screenshots to him and say, hey, look at this, see what it did here. Not being a participant in it. These types of scenarios happen all the time. But the very, very choice setups for you to get in, they're not as frequent as these are going to be. Let's take a quick look at the Dow once more, see if it's changed anything. I'm still working on one screen because I want to, again, emphasize the importance of, look at that, so it's going the other direction. And then ES, let's take a quick look at that. No real expansion on the downside, but it still has its sell side right there. So as you can see, a rather anemic opening range gap again. And it just happens that the first fair value gap forms actually in that same area as well. So we have taken sell side on a mixed decoupled AM session during the opening range. We have a couple more minutes still for the first 30 minutes to book. Now, two scenarios on a morning like this where the averages are doing different things. Dow's going up, NASDAQ best performer on the downside, and then you have the ES that is moved a little bit, but it hasn't quite made the same type of delivery for its sell side down here yet. So it's being, like I said, it's snubbing any weakness, as I was indicating earlier. Like, I want to see if it fails to go lower. If it does that, it's going to run for the buy side here for ES and maybe explore the orders up in that area there. Not that it needs to know how many orders there are, but that's where the buy side would be. These two highs, with this one being lower than this one, and then this high over here. Let's back it out a little bit, and you see these really clean little, almost too perfect, isn't it? So if it fails to go below the sell side, NASDAQ tries to come back up into its range. That would be where my eye would go to for ES, but it's conditional. So notice I'm saying these things have to accompany other things. It's not just simply me saying ES is going there. We'd still have to work out the uncertainty of this sell side being taken or not in agreement with the NASDAQ returning back up into its range. That would indicate that this could potentially become an inversion fair value gap if that is what is likely to see unfold. And that may support a run back up into maybe the first delivery to first to the fair value gap and back into the opening range gap, which is kind of sharing the same real estate in terms of price range. And I'll go back out to regular trading hours just for a moment to show you what I mean by that. So we have the settlement price here yesterday. I'm just going to use it with the lines if you don't mind. And we'll annotate with this. Oops. And then the opening price today. And then we can go back out to electronic trading hours. So you can see there's two frames of reference in here. We have the first presented fair value gap that never got traded to yet, despite being delivered to the downside and sell side. It did not get traded back into here after creating it. So this candle never made it up there, and no subsequent candle after that made its way up there. So the consolation prize was that we could see this fair value gap forming here. And the bodies were laid down and buried right at the consequent encroachment of that separation between this candlestick's low, that candlestick's high. And the wicks were permitted to do the damage. So this is just simply returning back into these two consecutive up-close candles, where because they're two consecutive up-close candles, you use the opening price of the lowest. That's this one right here. That's your order block or change in a state of delivery, where price was delivering buy side. That means it's moving higher, and then it changes and goes lower. So the change in a state of delivery is that opening price, and you can see it going right there, and it returns and trades lower. Just for good measure, it turns right back to this candlestick's low as well. Look at the low of that, 20,307 even, and the high comes in 20,307.25, which is a perfect delivery to this candlestick's low plus 1 tick per spread. One more quick look at the Dow. Again, being a brat, doing what it wants to do. And ES. Okay, let's extend this out a little bit more. See, we've already hit it there. Watch the consequent encroachment of this wick. See, I hit that right there. And in a perfect world, it would roll out of this and go down and attack its sell side liquidity. See how it's very, very difficult to frame any kind of stop loss in all this if you're trying to be short. So that's one of the things that you're just going to have to accept that there are going to be times where you're not being afforded a very low risk entry or an entry at all, despite knowing where it might potentially still trade to. Some neat little turn back up into the opening price there. Hammered it perfectly. There's nothing in here to frame an entry on. So the only thing we're really watching and observing is, does it have the ability to rotate out of this and attack the sell side, which is the only thing that makes sense down here. Doesn't mean that it can't go higher. It just means that if it does, who cares? You wouldn't have been short because there's nothing in here to frame it for the risk. There's no way to feel good about taking the trade because you have decoupling. So I'm speaking to the folks that are trading ES, by the way. Whereas if you had a lot of things going in your favor, where all the indices, all three were in agreement, they were moving in the same direction. We traded back to the first presented fair value gap, and then it showed displacement after that. Then it's easy. We could drop down to a 15-second chart and take the very next fair value gap and trade, in that direction. It need not be complicated. I'm looking at this little gap right here. Yeah, should be rolling over. Really ugly. Really, really ugly. All right, so I'd like to see if it can come back up in to the range here. It's done enough exploring for me. If it wants to go back up in here, I would like to see it come back and trade back into the opening range gap. Would not want to short it. Would not be interested in chasing it lower. S&P is shrugging off any willingness to want to go lower. So look at the low here at 951 to present. Okay, and then look at the NASDAQ. Lower, in NASDAQ, which is what we expected anyway. We wanted to see the NASDAQ lead to the downside. But the S&P I mentioned earlier, I said I'd like to see if it's going to show an unwillingness and kind of like shrug off any weakness. We've seen that thus far. So in other words, the S&P has not been wanting to go lower, and you can already see how it's showing its willingness to want to go higher now and not go lower. Focus in here and over here. And then the minor one is here. And the Dow, still wanting to do what it wants to do. The old brat. All right. And I think we're a little too far extended to want to come back into this. I mean, it can, but I wouldn't demand it. And now this one right in here. Remember I was telling you earlier that could end up becoming an inversion fair value gap if we were to trade back into the range after breaking out below to the sell side, we've seen so far over here. Now sell side resides here. And what we want to see, what I would rather see is Dow continue doing what it's doing, going higher, or consolidate, not drop. Let me go back into the Dow. Dow either stays going higher or consolidates and allows ES to hold its ground, not break below this low. We don't want to see that. And notice this wick that I was drawing on, this consequent encroachment. It stopped it here, traded back above it, and then the bodies, consequent encroachment of this wick, and then the low of that candlestick right there. You see that? And then this volume imbalance, we traded through it, and look what happened right here. The body stopped on that high of that volume imbalance, and it stopped on the body right there at the open and started rallying. And it went down into it, but didn't breach it. See that? It's interesting, isn't it? Back into this fair value gap, but the liquidity rests here. So it doesn't make any sense for it to come all the way up here just to get to that. It's already shown it's not wanting to go to its own sell side, which was down there. It's a me thing to justify why I don't have to have a return back to that inversion fair value gap, because my compensation is I just go in when I know I'm bullish, I'll just enter inside of the inversion fair value gap as it touches the candle that enters it, which is here. We saw that there. And I said, or I'll just go in at the consequent encroachment and look at the bodies of the candles right there. You see that? And then we've already delivered here. So this is right here more than most of the folks you see on live streamers that they're trying to capture something like that. All live, explained to you, even in a little bit more difficult market. See how we just keep gaining ground and we never came back into what would be viewed as inversion fair value gap. If you're extremely bullish and what you've already outlined or anticipate as an inversion fair value gap, if you're bullish, and if you're really, really bullish, why would you wait for it to come away from it and then come back down? It's teaching you visibility through this chaotic decoupling between the three averages doing all different things. I'm pulling out the things that are salient. What would be catalyst for the market to see it back into its range? The S&P would shake off any weakness. That means it sets the stage for what? SMT divergence, which it was not willing to make lower lows here. When the NASDAQ was able to make lower lows. And now we're trading up into this gap here. So we want to see, does it want to trade? It can accumulate in here and run right out of that. That's one of the caveats to an inversion fair value gap. If a market's extremely strong and you're expecting it to perform like I've outlined here before we even move back up into it, I said once we hit sell side, if the ES fails to shrug off, if it fails and shrugs off weakness, that means it fails to drop down, which is what we've seen so far. Then this could become an inversion fair value gap. And then we watched the NASDAQ create lower low, but then the ES failed to make a lower low at the same time that the NASDAQ did that lower low, at the same time that the Dow just keeps going higher. So the way these indices could come back into agreement and become symmetrical is Dow stays consolidated, don't lose any ground, don't go lower, or keep going higher, and then ES fails to make a lower low, and that's what we've seen so far. NASDAQ makes the lower low and then comes back into its range and uses this as an inversion fair value gap. Now the caveat is it can just leave this thing and never come back down and touch it and use it as a discount array. So that's why sometimes if I'm really convicted on the idea that I think the market's going to go higher in this instance, I'd be taking the trade as it's hitting this candlestick's high right there, or trading right at this point now because it's in consequent encroachment. I'm just going to highlight the midpoint of it, so that way it kind of like highlights the halfway point. In instances where it's really bullish, it affords me to get my first 6 contracts on, and I may not get my 4 contracts if it comes back down and touches the high of the gap, which is this candlestick's low. So that's why many times if you look at my examples, I'm entering inside of an inversion fair value gap before it actually proves itself to you as my students, because I understand a little bit more what I'm looking for. And I've also had instances where it just runs right out of the inversion fair value gap and I don't get either my fill or my second partial to build into a pyramided position. So it's kind of like a knack thing. I don't have any rules that I could adequately explain to know when it just runs away from the inversion fair value gap. It just happens. It's kind of like the same thing we've seen here, where I identified for you the first presented fair value gap, but it didn't deliver to it as a short. Okay, well, because it dropped lower, we watched this thing pretty closely this morning. We called out the S&P potentially shaking off any weakness, and then the Dow keep going higher. So we have a decoupled market, and we were able to still see certain aspects in what price is likely to do. It doesn't mean it's going to always do it. I get it wrong a lot when it's decoupled. Don't think for a second I'm trying to sell you on the idea that I'm 100% inaccurate when there's a decoupling between the 3 averages. When I say it becomes complicated and complex for precision, I mean it, because there's a lot of things that would otherwise be in play that I could point out to and say, well, look at this and look at that, look at that. We're seeing a lot less of that here. There's enough of them, obviously, for you to scratch your head and say, wow, there really is something to this. But it's not enough for me to feel convicted enough to get in there and press the button and enter with real money. So if I know I'm bullish, once we enter this area in here, I already have the conviction that I want to see it, use it as an inversion fair value gap. So why would I give up the opportunity to take an entry at a very low price inside that inversion fair value gap, like at the top of that candlestick here, or at the mean threshold, the consequent encroachment, which is the midpoint of this gap. And you can see the body's delivering on that basis right there. And that to me is, again, a signature that I try to press upon you as my students to say, look, what's the chances of that happening, where the body's close and open of the second candle occur right at the midpoint? These are things that I keep teaching you to look for. I'm watching this little gap right here. I know it's hard to see because I got my watermark on it. That little gap right there. I don't want to paint over top of what I already have here, because I'm watching, does it want to just spike into this and then try to continue on? Or does it want to use this order block right here? I'm waiting to see if it can get up in the first presented fair value gap. That's kind of like really what I want to see, and I'm hoping it could do that before we close session. But if it doesn't do it by 10:30, I'll leave you with my comments before I close the stream down. But this is enough. This is a profitable study so far, because we're working in a problematic condition. So we're back inside that order block I was mentioning right here. Still could come right back down in and hit that inversion fair value gap. It's not out of the realm of possibilities. It still can do that because there's a little gap in here. But preferably, I'd like to see that stay open. If I could see that stay open, that would fuel a run higher than the first presented fair value gap and the gap closure. And then it's even here, but more so back to this buy side there, that line. So you have to be a little bit more reserved and say, okay, I'm not trying to force a trade, but I am going to watch price action and see if these things that are being outlined are helpful. Are they indicating anything in terms of prognostication? Did you see the ES? Let's go back to it real quick. Did you see the ES shrug off its unwillingness or not want to go down to its lows here? It showed an unwillingness to do that, as we indicated this morning. And it would run for the buy side here, and it would run over here to that. But when we go back to the NQ, make that in your documentary. We have the market making that lower low in NASDAQ, as I indicated, would likely do after it took its initial sell side. Remember, it was a little bit higher up here. It went down below it, and then I wanted to see it trade back into its range if ES failed to make a lower low. So what did I do? I forecasted a SMT divergence before it happened. I told you that we would see it return back into its range and come back up into the first presented fair value gap. And thank you so much, Phil, for being a gentleman today, allowing it to happen before 10:30. And we're back inside the opening range as well. So what I would like to see it do is just power on higher up and punish those that are short, that have their stop loss sitting right there. And if they're going to run that high, then it's reasonable to anticipate that little Lego looking area price action I was mentioning earlier. And the decoupling, again, is the unwillingness for all three averages to move in the same direction. Okay. And as soon as you see this, this is what you want to write down in your notes too, because I didn't mention this earlier. As soon as you notice that there's decoupling between the three averages where the Dow was going up initially, let me do this because I really want to be able to show it to you. So here's the NASDAQ chart, and then we're going to put the Dow here. So here is the ES. Here is, let's 1 minute chart on that. The Dow. Yeah. Okay, so we've seen at 9 o'clock this morning, the ES, it drops down. At 9 o'clock in the morning here, we have a little bit of movement lower, and then the Dow says, oh, absolutely not. I'm not interested, and starts going higher. At the same time, the S&P was going lower. And at the same time, we see the NASDAQ dropping down. Okay? In all this mess here, because there is no symmetry, meaning that the Dow was going one direction, S&P was going lower, and NASDAQ was going lower. That's fine. How can I still read the NASDAQ like I did? Because I had the coupling that still existed directionally with the ES. I don't care so much about the Dow. The Dow tells me I'm in a decoupled state. That means I'm going to lose a lot of precision. That means I'm going to lose a lot of resolution in visibility of reading price action in my NASDAQ. And I'm definitely going to have a lot of resolution issues in the ES. It's going to cause like a fuzzy, out of focus picture. Even though I can see it's likely to keep going down, and I told you, and listen, you're going to go back and listen to the stream and hear me say this. I want to see ES shrug off any willingness to go lower by shrugging off weakness. That means a failing to go lower. If it fails to go down, take its sell side. That's what I want to see. I'm waiting to see that. That means if I'm expecting the NASDAQ to go lower, that's going to do what? It's going to create an SMT divergence. That means it's going to fail to make a lower low on ES when the NASDAQ does make a lower low. And then the NASDAQ will go up back into its range and trade back to its first presented fair value gap. I predicted with the logic explained to you in this live stream why the SMT divergence would occur. In which one? The ES would fail to make a lower low. It would shrug off weakness. I knew that was going to happen. This is what you're writing down in your notes. When you see decoupling, and generally you're going to see the Dow become that little brat. That's its usefulness to me. I don't care that if the Dow makes a lower low and the S&P fails to make a lower low. I don't see that as a divergence. That's not, to me, that's not SMT. Because I know that the 30 stocks that make up the Dow are not that impactful overall. But they will normally bend to the will of both the averages when ES and NASDAQ are going lower. It goes without reason. It goes without saying that all boats rise in high tide, and they all they drop in low tide. Okay, that's the analogy here. So when it's really, really moving, the Dow should be moving in sympathy with the ES and NASDAQ. But if in the morning session we open up and it starts doing like it did this morning, that means I already know that I'm going to have visibility issues with the precision. So then I have to go back to, okay, that means that we're decoupled. So at some point later on in the session, there's going to be a SMT divergence, and they're going to go back in sync. The Dows is simply telling me, no, we're not going down there right now. So I'm going to be looking for what? I'm going to be looking for the S&P, because this one's going to be fuzzy compared to the obvious imbalances and stuff that we saw over here that I annotated, and you can see the prices reacting off of. We're seeing a lot of overlapping in here. Let me magnify this one again. We're seeing a lot of the give and take, back and forth delivery of price here. Every candlestick, the range keeps overlapping with the previous one. There's a lot of revisiting of the same prices. So this is like fuzzy type of price action compared to, see how much more nice and refined every little range. We were able to see the bearish fair value gap here, the change in the state of liquidity, bang, hits it. The body stayed inside the volume imbalance here. We have a volume imbalance here. The body starts in there and leaves it. Doesn't come back up into it. That's weakness. Drops down. I told you this is going to be an inversion fair value gap, but I also said it may not even come back down and touch it. And I told you how to use that inversion fair value gap as an entry, how I would use it, and how I would use it to make sure I get into the trade, because I may not get that, which didn't come, the return and reprice back down into it. And I told you I want to see that fair value gap stay open. That would be a breakaway gap, and it would take us right back up into, what is this? Oh, look at the bodies here respecting the first presented fair value gap. The volume imbalance that I annotated over here, because this is all part of what? What is this? What is this right here? Market maker buy model. Does the market maker buy model have to come back up and clear out the original consolidation? No, it doesn't. It does not have to do that. But you have to know where it's going to draw to, and you were told that. The volume imbalance here, it trades above it, it comes back down, a tiny little bit outside of it, comes right to the top of it, and then sends it right into the promised land, the first presented fair value gap.